Money feels real because we trust it, not because it has weight, not because it shines, not because it can be eaten, burned, or used to build shelter. Money feels real because every person around you agrees to pretend it is. The bill in your pocket, the number on your phone, the balance in your bank account, all of it relies on a shared belief that these symbols represent value. But here's the uncomfortable truth most people never stop to consider. The vast majority of the money you use was never printed, never mined, never backed by gold, and never existed before someone typed it into existence. It was not discovered. It was created. When you walk into a bank and take a loan, something counterintuitive happens. The bank does not open a vault and hand you money that someone else saved. It does not transfer existing wealth from one account to another. Instead, it creates new money with a keystroke. A digital entry appears on a screen. A number increases. And from that moment on, that number behaves exactly like real money. You can spend it. You can invest it. You can lose it. You must repay it. The money feels real because the consequences are real. This idea sounds illegal. It feels like counterfeiting. And yet, it is not only legal, it is a foundation of the modern financial system. To understand how this became normal, we have to go back to a time when money actually was something tangible, when wealth was heavy, when value could be locked behind stone walls and iron doors. Centuries ago, banks were not creators of money. They were guardians of it. People deposited gold, silver, and valuables for safekeeping. In return, banks issued paper claims, receipts promising that the bearer could redeem them for real metal at any time. These notes were not money themselves. They were promises. And for a while, those promises were honored. But bankers noticed something important. Almost no one ever came to claim all their gold at once. Most people trusted that the gold was there, so they never checked. That observation changed everything. Banks began lending out more paper claims than the gold they actually held. If 10 people deposited gold, the bank would issue claims to 20 people. As long as not everyone showed up at the same time, the illusion held. This was the original gamble of banking. Confidence over certainty, trust over proof. That gamble worked until it didn't. When panic spread, when rumors circulated, when fear replaced trust, people rushed to the banks to reclaim what they believed was theirs. And the gold was gone. Those moments became known as bank runs. Doors closed. Fortunes vanished. Economies froze. But instead of abandoning the system, societies chose to formalize it. What began as a risky practice became an official structure. This structure would eventually be called fractional reserve banking. Fractional reserve banking is simple in theory and profound in consequence. Banks are only required to keep a fraction of deposits as actual cash. The rest can be loaned out. That loan becomes a deposit somewhere else. That deposit becomes another loan. And each cycle multiplies the total amount of money in the system without adding a single physical unit of value. Money does not move through the system. It expands inside it. This is why most money today does not exist as cash. It exists as digits, numbers in databases, entries in ledgers. When you swipe a card, nothing tangible changes hands. When you transfer money, no object moves. The system updates a balance and adjusts its records. And everyone agrees that this update represents real value. Confidence is doing the heavy lifting. But confidence is not permanent. It is emotional. It is psychological. It can disappear faster than it forms. When people begin to doubt, when they suspect that the money behind the numbers may not be there, everything changes. Withdrawals increase. Liquidity dries up. The system strains under pressure. Banks are exposed not as vaults of wealth, but as networks of promises. This is the moment where central banks enter the story. Central banks exist to protect the system from its own fragility. When commercial banks face collapse, central banks step in as lenders of last resort. They create new money to replace the money that never truly existed. They inject liquidity to restore confidence. They stabilize the illusion. From the outside, this looks like rescue. From the inside, it is maintenance. Every bailout, every emergency loan, every stimulus package follows the same pattern. Money is created to fix problems caused by money creation. The system survives not by correcting itself, but by expanding. and each expansion has consequences. When more money chases the same amount of goods, prices rise. Inflation is not an accident. It is a pressure release valve. It spreads the cost of system stability across the entire population. Savings lose value. Wages struggle to keep up. Assets rise faster than income. Those closest to money creation, banks, corporations, asset holders, benefit first. Those furthest from it pay last, and often pay the most. This is not because of a secret conspiracy. It is because of structure. The system rewards proximity. If you receive newly created money early, you spend it before prices rise. If you receive it late, through wages or benefits, you face higher costs without higher income. Inflation is not equal. It is directional. Over time, this creates the appearance of inequality without a single visible villain. Wealth concentrates not through theft, but through timing, through access, through position within the system. The machine does not need to be evil to produce outcomes that feel unfair. It only needs a function as designed. And the design persists because it works, most of the time. The modern financial system does not collapse often because it does not need to. It only needs belief. As long as people trust that digital numbers equal real value, transactions continue, markets move, economies grow. But this stability is not guaranteed. It is maintained, reinforced, defended. Every financial crisis is a moment when belief wavers, when people see behind the curtain, when the gap between numbers and reality becomes visible. And after each crisis, the system is rebuilt larger, more complex, and more dependent on trust than before. This raises a question few systems want asked. If money can be created from nothing, what does it actually represent? If value is not anchored to physical reality, what anchors it at all? And if belief is the only thing holding the structure together, what happens when belief runs out? These questions are not theoretical. They shape policy. They influence behavior. They determine who feels safe and who feels exposed. Understanding how money is created does not make you immune to its effects, but it changes how you see the world built around it. Because once you realize that money is not real in the way you were taught, you begin to notice something else. The consequences are real. The stress is real. The inequality is real. The pressure is real. The system may be abstract, but its outcomes are not. And that is the paradox at the heart of modern finance. Money is created from nothing, but nothing is free. The cost is simply distributed in ways that are easy to ignore and difficult to trace. Quietly, gradually, systematically. So the next time you see a number increase on a screen or hear that billions were created overnight, remember this. Money is not a thing. It is a relationship, a promise, a shared belief. And like all beliefs, it survives only as long as people continue to accept it. When that acceptance fades, history shows us what follows.